Welcome to the Broken Pie Chart Podcast, episode 63. I'm your host, Derek Moore. This week, we're going to talk about this whole thing about spreads widening. You've probably been watching CNBC and heard people talk about spreads are widening. The high yield spread has reached, 1,000 basis points. And, yield spreads deal with, and I'll explain what they are in a second, but they inform us about what theoretically various types of parts of the bond market are requiring in a return versus, let's say, a US Treasury. And so a lot of times when you see markets sell off, uncertainty come in, you've got these spreads that widen. And actually, sometimes spreads widening can be an early indication of, let's say, some trouble in the equity market or vice versa. Sometimes you see spreads firming up, meaning coming back down. And that could be a good indication that, sometimes the bond market actually recovers prior to it. And then finally, we'll sort of look at the different ratings, what they mean, what we say, the junk spread, the triple C spread, all those types of things. And we'll also kind of take a look, just in general, while we want to keep it a little more high level, this idea of one of the things that you see when markets sort of dislocate a little bit is some of the pricing on bonds gets a little bit out of whack. And one of the reason is, unlike a stock or an ETF that has a bid and an ask and it always trading and price discovery is normally there, although equities get a little out of whack when as far as price discovery when you have really big sell-offs or things like that. But the bond market works a little differently, and so we'll get into some of those aspects. So first of all, what exactly is the spread widening? What does high yield spread mean? What does that actually talk about? So think about it this way. When you're looking at the spread, you're looking at the difference between one thing and another thing. And I'll link to all these. You can actually get the spreads within the Federal Reserve Bank of St. Louis, otherwise known as FRED. And in fact, if you Google FRED and do high yield spread, you can pretty much find it. But I'll give you an example. Let's say that a basket of high yield bonds, they were, let's say, their yield. Actually, let me go back. So right around mid-February, the high yield spread, and this is the option adjusted high yield spread, and I'll explain what that means in a second. But back on Tuesday, February 8th, feels like November 8th, or it feels like a lot more longer ago, it was 3.61. So what does that mean? It means theoretically the bonds would have a yield to maturity of around 3.61, or we'll just say yield for now, keep it simple, above what treasuries are paying. So let's say treasuries were paying 1% annually, and your basket of these high yield bonds were paying 4.61%. Okay, you can see the difference there. It's the spread between the yield on high yield and the yield on treasuries. And, I don't want to get too granular on this, but you can sort of see that, basically that's what currently the yield theoretically that investors are requiring to hold high yield. And one of the things that's notable, while it has, was lower, let's say, early in the year, 3.38. If I kind of look at a max view, back in May of 2007, it was 2.46. And, in November of 2008, it reached a high of 19.88. So recently, that actually hit a high of, about 10.55% before coming back down. And I think just on Wednesday the 1st, and these don't update real time, it was about 9.11. And so the first thing is when you see yields widen, it means that investors theoretically are requiring a higher yield for holding those bonds versus treasuries. And so think about it this way. Again, it's the difference between the yield on high yield and the yield on US treasuries, which of course are, considered risk-free, especially on the short end of the curve. Longer end has interest rate risk, but that's sort of the difference. And when you see markets that have some sort of an event like we just had, you would expect yields to widen. you would expect yields to widen, obviously, over treasuries. And when yields get higher, remember, bonds and interest rates have sort of this inverse relationship. So when interest rates go down, bond prices go up. It's the inverse. When yields go up, bond prices go down. And part of what makes the yield higher is that, all else equal, if you had, let's say, a bond that paid 5% annually and it's trading at par, if we just think about one bond now, and all of a sudden that bond goes down to, 70 or $700. Well, I said the original one was $1,000 and it paid 5%. That's $50. Well, now when the bond goes down in price, let's say, what did I say it went down? I said 50 divided by, 80, right? Or 80. Yeah. Let's do 800. So that yield is something like 6.25%. This is a real back of the napkin thing. Bonds you have yields and maturities, and the price and everything else gets involved there. But as bonds went down in price, you sort of see the difference. And really, when we think about bonds, we're thinking about not only the bond's price, but the coupon it pays. And so the way to think about this is when risk-off markets, when you see spreads widen, you're actually going to see yields widen. And that's what we saw this time. We saw with high yield spreads started to widen. Now, when you think about, and this is another important thing, I like to use what's called the option adjusted spread, or the OAS spread. And all that means is, let's say you have a group of bonds or a collection of bonds, and sort of duration matters, meaning the amount of time to maturity. But bonds have something called a call provision sometimes, and corporate bonds. So let's say it's a 10-year bond, but they could call the bond away at a certain price next year. Well, typically what happens is the pricing takes into account that feature. And so when we say the OAS, or the option adjusted spread, you're really thinking about taking into account any call provisions, any special features, anything like that. So I like to use those versions. But again, when you hear people on TV talk about, oh, look at that, yields widened, they're talking about the difference between theoretically what you'd get on, let's say, a high yield bond versus US Treasuries. They also follow the investment grade, so the corporate IG or investment grade. They look at the spread between investment grade bonds and US Treasuries as well. And same thing, you'd expect yields to widen. And typically yields widen the most for the lowest rung, or the lowest, the poorer the credit quality, the more they typically, begin to widen. So also, when they say, a lot of times they quote this in basis points. So I said, spreads widen to over 10%. Remember, 1%, if you said that in basis points, that's 100 basis points. If it went to 1.01%, you would say it went up by a basis point, and now that's 101 basis points. So a lot of times you'll hear, hey, spreads went over 1,000 basis points or 1,000 bips. What they're talking about there is they're saying that spreads widened 1,000 basis points. That means it's 10%, right? It's just a way of quoting it in basis points versus quoting it in, percentage points. So the other thing I wanted to just touch on is we talked about, high yield. What does that exactly mean? Well, bonds have ratings. And of course, you probably heard there's 3 different rating agencies: Moody's, S&P, Fitch. I'll just kind of go with S&P's for now, because Moody's uses, capital letters, lowercase letters, and numbers. So it's easier in the sort of the vernacular to just quote S&P. So when you think at really high grade bonds, AAA rated bonds, and then you have like AA plus, AA minus, those types of things. Well, you get it, right? A is the highest, B is, and then you have C's and D's, right? So without going through all of these, generally you would, investment grade bonds or anything triple B, and that includes the pluses and minuses, triple B and higher, all the way to triple A. And the triple Bs, by the way, are the last rung on investment grade, before, if they were to get downgraded, so recently Ford, I think one of the agencies downgraded their bonds to junk status. And that means that if they were, let's say, double B minus, or Moody's, it would be B lowercase a 3. That's why I'm sticking with the S&P, is a little easier. So if triple B gets downgraded, and then it goes below that, that's where you get into speculative or junk status. And so bond ratings are generally, the rating agencies, in theory, they're supposed to look at the risk, because when you buy a bond, that's why I say it's a credit instrument, because you're extending credit. So if you buy, let's say, a Tesla bond or a US Treasury bond or anybody's bond, you're in theory loaning them money. They've agreed to give you usually semi-annual payments over a number of times. Sometimes they have the ability to call that bond or call that loan in early, but basically you're extending credit. And so spreads widen at different areas on the curve differently. And so to give you an example, this was from March 12th, and high yield in general at that point, it had gone to 726 basis points, the spread. And so that would be 7.26%. Remember I said it was 3.58 or 3.38 before spreads started to widen with the market action in late February. But to give you an example, from the 12th of March, broad high yield was about 726 basis points. But then if you go up to investment grade, it was only 209 basis points. So that's only 2.09%. And that's above whatever the Treasury was. And so, yes, in theory, like if Treasuries came down and everything else stayed equal, you could also see spreads widen. But typically when you see spreads blow out or widen, that's some sort of a credit event or a market event that happens. So, and then if you look, let's say at, so triple B, that's the lowest rung on investment grade, that went to 277 basis points. Again, this is March 12th data. But just in, double B 530, single B 808, and those are both junk, and then triple C and lower, 1,526. So you can see the lower the credit quality, the more that those spreads widen, and that would make sense. Interesting, though, in a side note, obviously, if people have been following sort of the stuff that's been going on in oil, and obviously as oil has gone down, a lot of people look at that as putting stress on various parts of the oil market. Energy's high yield spreads, and this is getting this on something that was published on State Street, who makes the spiders, the different ETFs. But it looks like high yield, even above 2008 levels, went actually about 18% above U.S. Treasuries. Again, that was as of March 12th. And so different areas of the different pockets of, let's say, high yield or investment grade can also widen as well. And so the thing you should take away from this is that the lower the credit quality, the more those spreads tend to widen, and then investment grade widens less. But typically when you see some sort of a credit event or a market event, you would expect to see yields widen, people go to treasuries, but also remember, a bond is simply, we call it the credit market, because when you buy a bond, you're essentially loaning an entity, whether the U.S. government or a company, or you're loaning them money, and their ability to pay that back over time informs as to the value of the bond, the rating of the bond, and then how much extra interest, let's say above something like a U.S. Treasury, investors would demand. And so those are really, and I'll put links to all these. Nice thing about the Federal Reserve Bank of St. Louis, or Fred, is they have tons of free information. You can pull these up. You also can, they don't print intraday, but normally the next business day, you can kind of see what spreads did. I guess if you have a Bloomberg machine, you might be able to see it real time. But the other things too that to mention just with bonds is that a lot of people are probably buy bonds through exchange traded funds, and if you buy them through exchange traded funds, obviously you've got people managing the fund, and they buy the bonds and things like that. But one of the things that people may not realize is, bonds aren't necessarily, they don't work like stocks when you think about trading. In other words, you've got different trading desk. It's not necessarily, I'm trying to explain this in the easiest way possible, but it's not like you have a bid ask and there's market makers. They work a little bit differently. And bonds don't trade all the time. So you might have a company's bonds that traded a week ago and they trade again today, and maybe the market today is a lot different. And so it's just something to keep in mind, with regards to how bonds work. The other thing I think it's worth bringing up is generally when people look at bonds, they think about what are the main types of risk. So a lot of times we think about interest rate risk, because if you hold bonds, let's say you hold US Treasuries and they're yielding 1%, 30 years, and interest rates were to go up 100 basis points or 1 point tomorrow, and you've got almost 30 years of duration, the exact calculation. Duration means what's your sensitivity really to interest rates, so to speak. Takes into account the bond's price and the coupon percent and things like that. But you would have significant interest rate risk. If you held a 30-year Treasury and 1% went to 2% tomorrow, and you got basically 30 years left, the market value of the portfolio might be down, something like 27, 28 or higher. But really, the other type of risk with regards to bonds is that a higher than normal level of defaults will happen. So remember, a credit or a bond, when you buy a bond, you're extending credit. And basically you're saying, I'm going to give you this money, you're going to pay me twice annually, and at the end of the duration or the maturity, you're going to give me my principal back. So usually bonds are issued at 1,000 or par value. You can buy them on the open market, higher or lower than that, but then you have the coupon payments. And so typically, in the high yield space or just in general, something like 3% or 3.5% is the average defaults. And so one of the things when you start to look at the price or the probability of defaults, it's a really complicated formula. The back of the napkin for a lot of people is they take a look at that yield spread, for example. But that's not entirely true, because that assumes what we call the recovery rate. And let's say, at normal bond, it doesn't default. You get to maturity, you get your $1,000 back. Great. You got your interest. Fantastic, right? Depends what you bought it at, but the recovery rate deals with if a bond does go into default, meaning they can't make the payments anymore, or let's say they get to the end of the term, and normally they would go to the high yield market and they would issue a new bond and use that money to pay off the old bond. But it deals with, do you actually get 0 cents on the dollar, or is there a recoverable amount? So, this is beyond the scope, and I'll be honest, I'm not an expert when it comes to recovery rates and bonds that actually default and what winds up happening to investors. Typically bonds are higher in sort of the food chain than stockholders or equity holders with regards to, if a bond, anyway, so they have claims, their claims are higher in stature, let's say, than equity holders. But there's a difference between if you think you're going to get, 40 cents on the dollar, meaning $40 out of, or $400 out of $1,000 value, or if you get, 10 cents on the dollar. And so to give you a good example, if you kind of look at, the probability of default, a lot of those things go into it. But if it defaults and you wind up getting half or you wind up getting more, so that's one of the main risk. And when spreads go higher, typically that's the market telling you, or they're implying that the probability of a certain amount of those bonds goes up higher as well. And so I think in 2008, default rates in high yield were something like 10 or 12%. I'd have to go back and look at that. But that's another thing to take a look at. Now, to give you an example too, I pulled some data. So this is just the high yield in general. as I said, most recently it peaked its head above 10% or 1,000 basis points. You'd have to go back to 2008, and I've only got this data back to, I guess, late 90s. But that peaked out at about 19.88% or 1,988 basis points. And again, the spread is just the difference between what the yield is on a basket of high yields or a basket of a section of high yields using the option adjusted spread. So you take into account bonds that have callable features or different options like that. And so recently we definitely, it was interesting. You kind of went straight up, went up above 1,000 basis points and came back down. So what's going to happen there? We don't know the future, but this is an interesting area to take a look at and to follow. And as I said, a lot of times a sign that things are normalizing. Sometimes the bond market you see spreads narrow a bit or spreads fall. And that can be a good indication either way. Look, we don't know what's going to happen in markets, but now if you watch CNBC or you heard somebody, you read a story say, hey, spreads are widening and spreads reach this or that. That's all they're talking about. It's simply the difference in yield between whatever bond group that you're looking at and US Treasury. So hopefully that helps you out. I will put a lot of stuff in the links as always. And again, rather than wasting time rating and reviewing and doing all that stuff, just go ahead and pass this along to someone that you think would be interested in it, and keep the comments coming. Go to razorwealth.com, contact me. You can suggest new episodes. This one was actually suggested by one of the listeners, so thank you. It's a good idea. All right, folks, have a good week, and we'll talk to you soon.